Ajay Argal is Senior Vice President and Portfolio Manager at Franklin Templeton. He's joining us now to take some questions. Ajay, good to have you with us here. Good afternoon, Prashant this side. Thanks for joining us. So just give us an overview, Ajay, in terms of, what's the lay of the land in terms of what the market's done and what you've been doing and basically where do you see opportunities, themes and sectors where some of your ideas are coming now, incrementally speaking?
Yeah, so as we all know, the markets have done very well in the last financial year. And we have seen that within that, the pockets have done even better. So large caps basically look at Nifty, then they've done reasonably well in terms of about 25-30% return if you look at the full financial year. And of course, the mid cap and the small caps have outperformed them by a very big margin. And within that, I mean, if you look at pockets like PSU, that they've done even better, and that outperformance is something like 70% during the financial year. So there are pockets of the market which are reasonably valued, and we think that that pocket is the large caps. So if you look at the Nifty valuations, they are about 20 to 21 times 1 year forward multiple, which is kind of broadly in the range of the last 10-year averages. But when you look at the valuations for the mid and the large caps, then the valuations are a bit on the higher side. So the mid caps are trading at around 25 to 30% premium to the Nifty, which is typically the peak relative valuation which they trade at. And there is very less point of time when they trade at anything more than that. And similar is the case with the small caps. So right now our focus is, and we are getting more ideas in the large caps and if you look at our diversified funds like Focused or FlexiCap, we are more tilted towards the large caps. In terms of the specific pockets or the sectors where we are getting incremental ideas, so we continue to see that banking and financial services is one broad pocket where the ideas are still coming in terms of growth versus valuation. So the growth is reasonable, though it is slightly slower than the last year, but still it is in the ballpark of 13 to 14%. And at the same time, it is the only sector where the valuation is lower than the last 5 or 10-year averages. So that combination of growth versus valuation is the best in this sector, though, as we all know, that this sector has underperformed in the last 1 year, and we had been positive to that extent. We were slightly early, but we think that given where the market is currently, given where the other sectors are, this sector is where you can look to kind of get incremental returns. Another pocket which has opened up is the real estate sector. And in the real estate sector, the cycle is playing out very well. So we had a long period of 10 years where the real estate prices did not go anywhere. But in the last 1.5 years, that has started picking up. And the reason has been that during the last 10 years, because the real estate prices didn't go anywhere, the affordability improved. And therefore, there was a lot of pent-up demand, and that pent-up demand is now coming into the market. And at the same time, all the developers have strengthened their balance sheet, and they are coming up with large-sized launches. And they are showing good pre-sales, and therefore the sales would follow. So there, the growth opportunity is very large, and the cycle has just started. So we are seeing some opportunities there as well.
You're saying the real estate cycle has just started, Ajay? Because, stocks have, doubled, tripled in some cases.
Yeah, so what I meant was the cycle. So cycle has started about 12 to 15 months back. And obviously, as we all know, the stocks started discounting the cycle a bit in advance. So to that extent, maybe another 6 or 9 months of good cycle is already discounted even from here. But typically, the real estate cycles, they go for 3, 4, even 5 years. So in that sense, we think that there is still some scope left in terms of the cycle.
Okay, all right. Hi, Ajay. Good afternoon and good to see you in. Nigel on this side. Two sectors that have done very, very well this year so far. One is pharma and one is metals, from opposite sides of the spectrum. Metals could be that rebound in China, but pharma, after doing nothing much for 4-5 years, that started 2024 in style. What's your view on both these two sectors?
Yeah, so the pharma is definitely because of the improvement in the business conditions. So if you look at the US generic market, which is had been a very competitive space in terms of the pricing. And if you go back about 12 months or so, the US generic pricing was falling into double digits. So basically more than 10% was the fall year on year for maybe 3-4 years before that. And what has happened is in the last 1 year or so, the US generic pricing, the fall, the pace of the fall has reduced. So we are falling at less than maybe 5% or so. So to that extent, the profitability of the companies which are catering to the US generics piece has improved, and that has led to a general buoyancy in the valuations and the expectations of the entire sector. Now, what we approach the sector is in terms of trying to find out niche opportunities within that. So we are not so keen on the plain vanilla generics in the US pharma space. So typically in our portfolio, you'll find that there are companies which are either catering to complex generics or who are catering to, let's say, the specialty pharma, which is a entire different space from the plain vanilla generics. And also in the domestic market, the growth remains very strong. And we have seen that one or two large companies also came up with their IPOs, which kind of led to a re-rating of the entire sector in the domestic pharma space. So any companies which are catering to that, either fully into the domestic pharma industry or parts of it, that have also got a kind of uplift in their valuations. So going forward, the opportunity remains quite robust, but the valuation, of course, as you have highlighted, are not so conducive now. So one will have to be more choosy, but this is still a space we are positive on, and we are primarily positive because we focus on the differentiated companies. As far as the metals are concerned, again, as you highlighted, that there is a bit of expectation of China rebounding. And at the same time, if you look at the Indian companies, they've been able to kind of control their costs well. And the Indian domestic market also has been generally having prices which are better than import parity prices. There was a premium, though that premium has now reduced quite substantially. But still, there is kind of a bit of protection for the domestic steel industry, definitely. And some of these companies in the industry are very, very strong in terms of operational parameters and having very low costs. So the opportunity is reasonable, but I mean, it is a cyclical sector, so you cannot have very large weightages or you cannot continue with them for very long.
Right, because of the cyclicality. Ajay, you started by saying mid-caps, small caps are sort of trading at expensive. Could you tell us, A, what to your mind is, what's the cutoff for mid-caps, small caps? And B, what, in your portfolio, right, what is the proportion? A fund manager I was talking to earlier was saying that if you ask me if mid-caps and small caps are overvalued, I would say yes. But that is only because I can't give you a 30-minute nuanced answer, because the space is so large, right, and is very dispersed. So when we look at the index valuation, it kind of reflects overvaluation in certain pockets, but there is a long tail of companies which perhaps is not very expensive. So just wanted your thoughts there.
Yeah, so I kind of partly agree with it. The part which I don't agree with is the long tail. There is a tail, but the tail is not long. So I think if I recall correctly, if you look at the Nifty mid-cap index, which is basically the Nifty 150 mid-cap index, if my memory serves me right, about 25% of the stocks there are trading at a multiple of greater than 60 times 1 year forward earnings. And about half of the stocks there are trading at a multiple of greater than 40 times 1 year forward earnings. So basically, large part of the mid-cap index, if you look at the mid-cap 150 index, which is the benchmark for all the mid-cap funds in the industry, then half of them is trading above a multiple of more than 40x. That doesn't mean that there aren't any enough opportunities at all. There are opportunities, but the opportunities are very limited. And so it's all about numbers. So the opportunities are much more in the larger caps is what I want to highlight. On your question with respect to how much weightages do we have, as I highlighted, if you look at our our flexi-cap strategies, basically the flexi-cap fund and the focus fund. We are having about 70 to 75% in the large caps and the remaining into the mid and the small caps put together. And just to give a sense, I think generally also, if you look at the entire market, about 70 to 72% is coming from the large caps. Large caps, when I say, I mean large, mid, and small caps, when I say it is as per the SEBI definition I'm talking about. So 70 to 72% of the market cap is within the large caps, and the remaining is within the mid and the small caps. So we are not too far away from that, but we are definitely not overweight on the mid and the small caps.
That gives us a good sense, Ajay. We'll leave it there for now. Thank you very much for joining us with that perspective, and hope to see you more often here on the program on CNBC. Thanks indeed. Well, Ajay Argal, Senior Vice President, Portfolio Manager at Franklin Templeton, coming through there. Well, IT major